All right. Thanks everybody for being on here today. We're going to jump in. So this webinar is going to set you up to buy a home in 2026. So we're here end of December, mid to end of December, 2025. And we're going to be looking at, first of all, well, I'll get into the slides, but we're going to be looking at what we can do to make sure that you are best prepared for buying a home in 2026. Now, this will apply to you whether you are buying at the beginning of the year, end of the year, anytime. It's not going to make a difference because preparation is key. So let's dive in. Hopefully you can see my screen okay for everybody that is on here live. I believe that you can. All right, so why it matters. First of all, why does getting prepared matter for you in your home buying journey? Most buyers wait. Most buyers wait till the last second. They sign up, look at stuff online, and they say, I'm just browsing. I'm not ready to do anything yet. I don't want to be called. I don't want to talk to an agent, talk to a mortgage broker. We're going to wait until we're actually ready. Being prepared is going to give you less stress. It's going to give you better decision-making, much fewer surprises. And we'll talk about some examples of some of these surprises that can come up as we get into this webinar a little bit. What we're going to cover today, we're going to start with preparing your finances for 2026. We're going to talk about what to expect from Ottawa's 2026 market. I feel like this is probably what most people are looking for. It's a big topic. There's a ton of really interesting indicators for next year that we will talk about. And then we'll finish with building a smart buying strategy with a little bonus for you at the end as well. So let's dive in. Early financial preparation is key. What this is going to give you, this is going to give you many more lender options. And the reason that it's going to give you many more lender options is because when you start preparing early, you're going to be able to see what lenders are looking for. You're going to be able to see what is going to hold you back once you get to it and keep some lenders out. And then you can make changes, you can make adjustments, you can move finances around to appeal to more and more lenders. The more lenders you can appeal to, the better rates you're going to get, the better terms you're going to get, the cleaner approvals and less stress that you will find. Lenders are going to be reviewing many items, but they're going to start by reviewing your income stability, which is, do you have consistent income? Is it salary? That's fantastic. Is it permanent? Even better. Government job for us here in Ottawa is one of the best things that you can have in terms of getting a mortgage pre-approval. As we know, once you're indeterminate with the government, it's very difficult to be pushed out of that role. And that's what a lender will like. They're going to want to see your credit history. They'll pull full Equifax reports. These date back 7 years plus, looking at all of your history, your credit card utilization, any car payments, any mortgages, anything that you have in terms of your credit. This report is going to show your debt levels as well. Next, they're going to want to see your down payment. They're going to want to see how much you have for a down payment. In addition to your down payment, you're going to need to have 1 to 2% of your purchase price aside for closing costs. We can talk a little bit more nitty gritty of what these closing costs entail a little bit later on or on a consultation, but this is something that they're going to want to see set aside. If you have a gift, a portion of your down payment is a gift, they'll need to see the proof of those funds coming into your account. And they may need to see the actual history of those funds in the gifter's account. So if a gift is coming from, let's say, a parent, they will want to see bank statements from that parent and see where those funds were ahead of coming to you. If you're preparing to purchase in 2026, some big credit do's and don'ts. Keep your credit balances low. Below 35% of your credit utilization is the ideal numbers that you'd like to see. Make sure you're paying at least your minimum balance, ideally your full balance on time. Don't let those start to carry over. Don't take on any new credit. Don't do large purchases. Those go hand in hand. No new vehicles. Stay away from that new Lamborghini that you've been eyeing. Don't go financing furniture. That's a big one that we see. People don't think it's going to affect anything. It will. So don't be taking on any new credit, any new debts as you're going into this pre-approval season. Owning a home is going to cost a lot more than just your mortgage payment. You've got a mortgage payment, you've got property taxes, you have utilities, maintenance. And when I put maintenance, that is a huge category. That can include condo fees if you're buying in a condo. That can include a roof leak. That can include a foundation leak. Maybe your windows need to be replaced. Maybe your kitchen faucet stops working, your furnace. There's so much that comes with owning a home. And this is for freehold properties and condos. Even on top of your condo fees, there's still things that can go wrong. Home inspection will be your best friend for knowing some maintenance items going forward, what you can expect to have as costs coming forward in the next few years. It's not perfect. You know, your home inspection can look at your furnace and it can be in great working condition during the inspection. You can move in a month later, still perfect when you move in. Fantastic. 2 weeks later, it can die. It can happen on older equipment. It can happen on newer equipment, sometimes still under warranty, sometimes it's not. When you're owning a home, you need to have a reserve fund set aside. Ideally, financial planners will tell you about 3 months reserves that you'd like to have. That's for all of your living expenses for 3 months that you could carry it if you lost your job or anything changes financially. So that's super important. This is also something you can use when those unexpected costs do come up, because they will come up. Some of the most common buyer mistakes that we're seeing are waiting for too long, trying to outsave the market, guessing affordability, using online calculators and saying, hey, this is what I can afford. Let's go out and look at houses. It doesn't work. There's a lot more that goes into an actual pre-approval and a mortgage approval than using an online calculator. The other item is ignoring those carrying costs. Look at your full monthly payment. Pre-approval is great. You see what the bank will allow you to purchase, but look at your monthly carrying costs. What does that mortgage cost you every month? What do the property taxes cost you every month? Get deeper. What do you spend on groceries every month? Can you afford taking on this new mortgage and still live the lifestyle that you're currently living? Or do you need to make changes? Are you willing to make those changes? Because once you own it, if you haven't looked into that before, you're going to be forced to make those changes if you haven't looked into it and see where your finances are currently at. So let's get into the best section. What to expect from Ottawa's 2026 market. Now, I enjoy stats. I love looking at stats. I love forecasting what's happening, using numbers to see what's happened in the past and what's happening going forward. All the numbers you see in here are actual data pulled from the Canadian Real Estate Association, pulled from the Ottawa Real Estate Board, also from my statistics of me being out with clients. So what actually drives prices? Prices are driven by supply and demand. Absolutely. Everybody knows that. That's basic economics. But what people don't consider is that affordability and confidence also have a huge impact on prices. We're going to see that in 2026. We're going to see supply come down. We're going to see supply increase. But what happens to prices is going to be impacted by the affordability as well as the confidence. So we talked a little bit about buyers waiting. Now, this is what happens to a $500,000 home from 2020 and how it's changed over the years. We've seen increases, we've seen decreases, we've seen things in these past 5 years that we will never see again. I don't expect in my lifetime to ever see mortgage rates under 2% again. And there was a lot, and we're seeing a lot of those coming up for renewal. So if we look through the years, and our interest rates, in 2020, a home for $500,000. 2021, it jumped up 26%. 2022, up another 7%. And then 2023 is where we saw our correction. Okay. This brought properties down. This is one of the first dips in Ottawa property values that we had seen in a long time. A dip at 5%. It's not as big as people think. Now, if you were bought in 2022 and you were trying to sell the next year, you were selling at a loss. It was inevitable. We are still seeing people from 2022 to 2025 selling at a slight loss. Okay, we've seen 4% increase over the last 2 years. That's total. So based on that 5% decrease that we had in 2023, we still haven't quite caught up. Typically, you want to look at real estate as a minimum 5-year investment. If you're going to be moving in less than 5 years and you know that to be true, you need to be extremely cautious. It's very difficult, and there's additional costs on top of just the home cost when you're moving. So it makes it difficult to recuperate your costs if you're not staying in it for a minimum of 5 years. Now, When we run statistics and go all the way back to the 1970s, one thing that's extremely interesting, every 10 years, without fail, from 1970s until now, sorry about that, that popped up there. Every 10 years from 1970s until now, we've seen prices double. This is without fail. I've got the graphs. I will show you. I don't have it in this presentation, but it's incredible. It doesn't matter. You'll see prices go up. You'll see prices go down. You'll see minimal increases. And there's always a year in there where you see large increases. And every 10 years, without fail, prices have doubled. Now, they haven't tripled. None of those 10 years have went crazy and tripled. None of those 10 years have only went up, say 50%. It's without question. That's what we've seen. Economics, it's supply, demand, but also affordability, inflation, what people can see. This can be expected going forward based on what we've seen here from 2020, okay? What we see in 2025. We have some growth to come. We've went up from 2020. Our prices, our average sales price is up fairly significantly. There is very good chance this average sale price in Ottawa is going up to $1 million by 2030. It's going to be 4 years away as we get into the next year, into 2026. There's a ton of information to look at here. So why do buyers wait? We know this. We know prices go up. We know there's dips, but we know that overall prices are trending upwards. Buyers listen to the news. You're hoping prices are going to drop. The market's going to crash. We're going to see it again. This is a bubble. It can't last. People are always talking about it. People wait. People are waiting for rates to come down. They think rates coming down is going to make their affordability go up. If we look at this, you look here, your interest rate went up, okay? Interest rate went up again. You're waiting for it to come down. Interest rates came down, but now you're up on your purchase price. Your monthly payment is actually going to be the same amount, if not less, back here when prices were lower and you're at a slightly higher interest rate. And in 5 years, if you took a 5-year term, you're going to go to refinance and it's going to look even better. So the fear of timing it wrong is another big thing. People try to time the market, but I tell people all the time, it's not about timing the market. It's about timing the market for your life. You need to do it when it makes sense for you. Don't rush it. There's never a time when it makes sense to rush it. If you're not financially ready, emotionally ready to be a homeowner, physically ready to be a homeowner in that location, tied to it for a little while, don't try to time the market. Do the market when it works for you. This is why waiting is often going to backfire. You'll see higher prices. You'll see more competition. Waiting for rates to drop, rates drop, competition increases. Every quarter point rate drop adds 100,000 buyers across Canada. 100,000 more competitors. We can break that down into our smaller market. We have Toronto, Vancouver, Montreal, and then Ottawa. A big chunk of those 100,000 buyers are going to be in those 4 markets. That's a lot more competition for every home that you're going after. You also lose time building equity. You saw the graph, you see the growth that we see year over year. People are building that equity. If you are trying to outsave that, it's very difficult. Real estate's the only investment where you benefit on the equity growth from the entire purchase price, and you only have to put down a small percentage of it. If we look at that $500,000 house, so you put down $100,000, okay? The market goes up 10%. You're getting a 10% growth on that $500,000, but you only put down $100,000. So you've nearly doubled what you've put down into it. That's a lot more than 10% growth. Inventory is going to shape your experience. This is not, it is going to change prices. But that's not what we're talking about here. It actually changes your experience as a home buyer. Low inventory equals more competition. High inventory, more options, more choices, more time to make decisions. So when we look over to the average sales price, and this goes by week, over the last 5 years. Okay, 2025 is not on this graph yet because it goes until the end of the year. Okay, and you're going to actually see where COVID happened here and what changed. So we start 2019 down at the bottom. Okay, 2020 increase as we get into COVID, bigger increase at the end. 2021, we've got in red. We've got a much larger increase here, the start of 2020 into 2021. 2022 is when we saw that peak. And really, the peak all came from this portion here, the first 3 months of 2021. It died down after that, and you can see we've had very, very consistent market from 2020 to 2024 in the end of, 2022 to 2024 towards the end of the year. No consistent changes month over month, year over year. People say that the spring market is the best time to buy. Look at the prices we've got here in what we'd call the spring market. Look at what comes a little bit later on. Okay, nothing really changes. Very, very minimal. This data is so close. You know, when you're looking at a difference of say $25,000 to $50,000 on an average price month to month, that can be one extremely luxury property that's sold. Maybe a beautiful Rockcliffe house sold for $4 million. That changes the stats. Maybe a couple really low end firehouses have sold. That can change the stats. This difference, 25 to 50,000 month to month, that's the same market. Each individual house is changing so little over those periods of times. Timing the market is not something that works. When you look at the winter, there's fewer buyers. There's also fewer sellers. The market stays fairly balanced. You have serious sellers, you have serious buyers, you have less tire kickers. Spring is going to be the highest competition, highest sales volume. The market moves fast. Prices don't change drastically. It's just fast moving. You need to be prepared. Summer comes back to a little bit more of that balance, a little bit slower pace than in the spring. Prices stay very similar. So supply is still a challenge because we have housing starts currently across Canada, and you hear housing starts in the government quite a bit. Housing starts are still at the same levels that they were in 1970s. What has our population done since the 1970s? It has skyrocketed since the 1970s. It's not even close. So why are housing starts still at the same level as our population when population has continued to grow? It doesn't make sense. This is why we still have a supply shortage. Had a ton of new builds start the last few years. You go downtown, you'll see it. You go down Carling, you'll see it. You go into Westboro, Hintonburg, Vanier, Beechwood, you're going to see these housing starts. It's a lot of condos. So what does that mean for freehold houses? We are so far behind. Our big builders, our Kaivans, our Mintos, our Madamies, they're not building homes the way that they used to be right now. The housing starts are way down. So why are prices likely to stay stable given what we're seeing? We just talked about housing starts are down. Supply is down. Why are prices going to stay stable? Affordability is what we talked about earlier, and this caps growth. Inflation numbers have been high. Grocery prices are out of this world. People are feeling tighter on what they can afford day to day. Truthfully, I think our lending ratios that people use based on our GDS and our TDS, so your debt servicing ratios that lenders will approve you for, I think that they're a little bit dated. What they approve you on doesn't take into account how much the average person has to spend on groceries to live these days, to raise a family, the cost of everything that adds into that. So while inventory might be down, there might be competition on houses. People can't afford $100,000 over what an asking price is like they could in 2020 before all of these prices increased. So if we look ahead to 2026, and this is what's happened in 2025, quarter one and quarter two are going to be our most accurate predictions. Quarter three, quarter four, we're guessing a little bit more, but they're still data backed. Okay, we'll have better ideas for those as we get into January. I'd say mid-January, I should have updated numbers on the Q3 and Q4. Okay, housing starts, you'll see, have remained fairly stable, but have been decreasing. Okay, since quarter two, were decreasing, and we're going to see a continuous decrease, but very stable into Q3 and Q4. Okay, existing home sales. Now, this is what we hear when you hear the news talking about the real estate market. It's a great market. The real estate market is so busy. People think prices, but that's not what they're talking about. They're talking about sales. Okay, the number of houses sold. So year over year, we were down last year, big time. You'll see Q4 down 6.4%. It feels like it was worse because the last year, 2024, was actually up significantly in that quarter. Look at our sales volume as we get into 2026. We're going to see 7 to 8% increases in the first 2 quarters of the year. There's pent-up demand. This was pent-up demand this year, okay? If you look at Q4 of 2024, you'll see the numbers were increasing. The predictions were to increase. What happened? Why did they not increase? January of 2025 is when we were hit with tariffs. Changed everything. Changed consumer confidence. Okay, we talked about confidence before. Confidence changes what people think in the market. Changes how people react to the market. People didn't have a clue what was happening next with tariffs. They were scared. They didn't want to make moves. That's what changed our sales here. Okay, that pent-up demand has not gone away. And this is why we're going to see the increase this spring. I guarantee it. It's coming. We're seeing it now. We have clients now out looking. We are a week before Christmas. I have clients who are actively searching, many clients. This is not normal. This is not what we see most years. People know that this increase is coming. Sales volume is going to increase, and they want to get in before it goes crazy. The home prices, you'll see as we get into next year, very modest. Maybe a small decrease in the first month of the year, first 3 months of the year. Small increase will make up for it in the next quarter. And then we have our modest increases going forward. Now, this is not 6% growth over the Q3 and 4. This is 3%. This is year over year for the Q3 and for the Q4. Those numbers were fairly stable. So this is 4% growth total. Okay. Modest volume increases. Stable pricing is what we consider this. This is where prepared buyers are going to win. So what do you need to do to build a smart 2026 home buying strategy? You need to know your must-haves and your nice-to-haves. We talk about non-negotiables, flexible items. I run through with clients, we do a 5-5-5 strategy. This strategy, we look at your 5 must-haves, mandatory. This includes location, includes price, anything else that is mandatory in your decision. You only get 5. If you're buying with somebody, it's 5 between the 2 of you. It's not 10. Okay. Then you get your 5 would like to haves. These are 5 items that would be nice bonuses, realistic. You should be able to find some of these like to haves, but they're not mandatories where you're going to turn away from a house just because you don't have one of these. And then you get your 5 wish list items. Perfect world. This would be amazing. We'd love to have this. Now, don't go crazy. We don't want to talk about having a golf simulator in your house and your budget is a $300,000 condo. Okay. We want to keep it a little bit more realistic, but these are more would like to haves, little bit wish list items. Okay. Your neighborhood. You need to do research on your neighborhood. Ask your realtor, have a consultation, see what neighborhood actually makes sense to you. You might have some ideas like Westboro, the Glebe, places you like, but affordability there is tough. So talk to your realtor and let's find similar places that line up with the lifestyle of those ideal neighborhoods that match your ideal neighborhood as well as your budget. Prepared buyers are able to decide faster. Okay, you have the market awareness. You've been tracking the market. You have clear criteria on what you're looking for. You're financially ready. You've been pre-approved. You have a rate held. So you can make a stronger offer. Now, a strong offer doesn't mean a higher price. Okay, it means clean terms. Clean terms is not firm. It means quick on conditions, not stretching your conditions for 2 weeks because you don't know if you're going to get approved for a mortgage. Okay, realistic conditions, matching what the seller's looking for. Can you work off their closing date? That might help you in price if you can match the seller's closing date. Can you close quickly on a vacant home? Again, more negotiation room in price because there's less carrying cost to the seller. Gives you confidence so you can see the home you like and you know that it's the home for you because you've done your research. You've looked through different neighborhoods. You know it's the location you want. So what you want to do is you want to avoid this buyer burnout. This comes from not knowing what you want, you know, being out there looking at 10, 20, 30 different homes, different neighborhoods that don't match your criteria. You'll get burnt out, believe me. You need to take it one step at a time. Start with your preparation. Have a clear plan and the right expectations. We offer a consultation to help you through this. So I'll link that at the end. So here's your timeline. Book your consultation first. Okay. Sit down with an agent. Talk about the market. Talk about what's expected for 2026. So many more stats that we can share with you outside of what's actually been on this webinar, because I could bore you to death with stats. I know not everybody wants to hear all of it, but I'm happy to share it. I'm happy to show you graphs. I'm happy to show you exactly what's happened. Okay. Get pre-approved. Go see a mortgage broker. Get a rate held. One thing people don't talk about is, everybody talks about the Bank of Canada rate adjustments. We know one, it just held the rates. There's lots of talk in the spring that rates might come down again. So you're thinking, why do I need a rate hold? When we talk about Bank of Canada rate adjustments, these affect the variable rates. They don't directly impact fixed rates. It's the bond yields, the Bank of Canada bond yields, that impact the fixed rates. It's not talked about. People don't talk about this. They change daily, up and down. And sometimes they're not lined up. So you may hear rates are going down, rates are going down. That's the variable side. What's actually happening on the fixed side? Hold a rate. If you see a lower rate, or your mortgage broker sees a lower rate as you get closer to your closing date, closer to making a purchase, they will bring it down. You will get the new current rate. If the rates increase, you'll benefit from having that rate held. There's no negative side in having a rate held for you. So it is never too early. The prepared buyer wins in every market. Get prepared. Start searching online. You don't need to be out at showings already if you're not looking to buy until the end of 2026. But start tracking the market. Have an agent track the market for you. Ask them to send you a monthly update on what's happening in the market, not across Ottawa, where you're looking. If you want somebody to provide that to you, let me know. We're happy to provide that. This is what allows you to make better decisions. So I hope you're taking away from this. I hope you're going to be able to walk into your home ownership journey with less stress, more confidence, and ultimately better decision making. So next step, book your consultation with us. We'll put the link in the chat right now. If you're watching this later, you'll see it in the description. And you don't need to be buying now. You just need a plan. Whether it's 2026, whether it's 2027, it's not too early to make your plan. I hope you got great value out of this. I hope you'll book a consultation, and we look forward to chatting with you in the future.